All right, let's dive into a really important accounting rule. It's one that's designed to keep a company's books totally honest. It's called the lower of cost or market rule, and it answers a huge question for any business that has stuff sitting on its shelves.
Seriously, think about that. You've stocked up on what you thought was the hottest new gadget, but boom! A month later, a better model comes out. Suddenly, the value of all your stock just tanks. What do? Well, that exact problem is why the lower of cost or market rule, we'll just call it LCM, even exists.
So first things first, what exactly is this rule and what's the big idea behind it? Let's get into it. At its core, the rule is actually pretty straightforward. You look at your inventory and you find two numbers. First, what you originally paid for it, that's what accountants call the historical cost. Second, what it's worth right now, that's the market value. The rule says your books have to show whichever of those two numbers is lower. Simple as that. So why do we bother with this? Well, it all comes down to a fundamental idea in accounting called the conservatism principle. Now that sounds fancy, but it's basically this. Don't get ahead of yourself and count profits you haven't made yet, and you absolutely have to acknowledge potential losses as soon as you see them coming. It keeps companies from looking way healthier on paper than they are in reality.
Okay, here's where it gets just a little tricky. That term market value isn't just what you could sell it for today. Nope, it's a very specific calculation. You have to find the middle number out of three different figures, what it would cost to replace the item today, a ceiling, and a floor. Think of the ceiling as the absolute maximum value you can assign, and the floor as the minimum.
All right, enough with the theory. Let's make this real. We're going to see how this works with a little story about a company and its widget.
It's really just a three-step dance. First, find the original cost. Second, calculate that special market value. And third, you just compare the two and pick the lower one. Let's do it. So here's our scene. It's New Year's Eve, 2025. ABC Company is closing its books for the year, and they've got 1,000 of these widgets sitting in the warehouse. The big question is, what are they actually worth?
Step 1, that's the easy part. We just look at the records. We see that ABC Company paid $10 for each widget. They have 1,000 of them, so that's a total historical cost of $10,000. That's the number that's currently on their balance sheet.
Okay, now for the main event, calculating that market value. Remember, we're on a hunt for the middle number between three things: the replacement cost, the ceiling, and the floor. Let's break it down. Let's walk through this together. The replacement cost, what it would cost to buy a new widget today, has dropped to $7. The ceiling, or net realizable value, is what they can sell it for minus any selling costs, which works out to $10. And finally, the floor is just that ceiling of $10 minus what they'd normally make as profit, which puts us at $8. So let's look at our three numbers. We have $7, $10, and $8. The number in the middle is $8. Now, you might be thinking, wait, the replacement cost is $7, but the rule has a boundary. The market value can't be lower than the floor, which we just calculated is $8. So $8 it is. That's our official market value. And now, the grand finale. Step 3, we take our original cost, $10 a widget, and put it side by side with our new market value, $8 a widget. The rule is lower of cost or market, so, well, the choice is pretty clear. We have to go with $8. So what does this all mean in dollars and cents? Well, the inventory used to be valued at $10,000. Now it's only worth $8,000. That means ABC Company has to take a loss, a write-down of $2,000. Okay, so they have to record this $2,000 loss. Where does it actually go? Let's take a look at how this impacts the company's official financial statements. Here you can see the before and after snapshot. On the balance sheet, the inventory asset value gets a haircut, dropping from $10,000 down to a more honest $8,000. Then, over on the income statement, that $2,000 loss directly hits the bottom line, reducing the company's net income for the year. It hurts, but it's truthful. But here's a twist. What happens if things get better? What if the widget market totally bounces back next year? This is where the rule gets really interesting, especially if you're following US accounting standards. So let's jump forward a year to 2026. Turns out, widgets are back in style. The market value has shot up to $11, which is even more than what ABC originally paid. So the question is, can they reverse that $2,000 write-down from last year? And the answer, if you're in the United States using what's called US GAAP, is a hard no. Once you write inventory down,
That new value, the $8 in our story, becomes its new cost. It's locked in. You can never write it back up. Now, this is a huge difference from the international rules, known as IFRS, which actually do let you reverse a write-down.
So, for ABC Company, even with the great news about the market, that inventory is stuck on the books at $8,000. The company will eventually see the financial benefit of that recovery, but it'll only show up as a bigger profit margin when they finally sell the widgets. The asset value itself doesn't budge.
Okay, let's pull back and look at the big picture. We've gone through the nuts and bolts, but why should you care about any of this? Why does it really matter?
When it comes right down to it, the LCM rule is like a guardrail. It protects investors and banks from companies that might be tempted to inflate their numbers. It forces financial statements to be conservative and, well, truthful. And you can bet it's a huge deal for regulators and auditors.
And hey, if you happen to be running a business with inventory, here's a really practical piece of advice. Don't just wait until the end of the year to see where things stand. If you keep an eye on your replacement costs all year long, you can see these write-downs coming and avoid a really nasty surprise when you're closing the books.
And that really brings us to the final thought here. The lower of cost or market rule is all about transparency. It forces a company to ask itself a pretty tough question, and it's a question we should all probably ask when we look at any company's finances. Is this balance sheet really telling the whole story? Thanks so much for joining me.